Welcome to PM Express Business Edition. Well, the Ghana city has been experiencing a lot of challenges, and depending on where you stand, there are projections that it has depreciated against the dollar by more than 30%. But in all these challenges and circumstances, how are commercial banks helping to manage the situation in terms of all these challenges? And also, even in the economic environment, how are they surviving? How are they making sure that when Kojo Mensah walks into that bank, he can still get access to loan at a very competitive rate, and all the advice that they'll provide to their customers? Surviving in the midst of this challenge, providing credit to those individuals out there, and ensuring that financial intermediation is not affected, as well as what these banks can do to help deal with the current pressure on the Ghana city. This and many other things as we engage the Chief Executive of the Ghana Association of Bankers, Mr. John Ewa. And thank you so much, Mr. Ewa. And how are you doing? It's quite an interesting time, some would say.
Yeah, a very, very difficult time for us as a banking industry, and also for the country as a whole. And as your introductory remarks, you know, the justice too is a time for reflection, deeper reflection.
How are you doing yourself as well?
I'm okay. I mean,
someone said you've moved from the industry, and so some would say that these are things that it always comes and then you manage to weather the storm.
Yeah.
I mean, as an individual first, not even talking about banking. I mean,
yeah. But I have sympathy actually for the bankers, particularly the bank MDs. I really have big sympathies for them, because these are very difficult times to maneuver your way and to also make sure that your bank, you know, stays afloat, do business, to help with the financial intermediation, and also not unduly absorb so much risk. So it's a very delicate balance that banks are having to manage, and I really commend them for all the good work that they are doing. So far, we've not had any hiccups, but we are hoping that we'll be able to weather the storm through these difficult times.
Again, it comes back to that individual thing, and I was asking, you were talking about what should be done to ensure that financial intermediation is not affected. I mean, how difficult it is in these times when you want to ensure that it is not affected. But listen, these are shareholders' funds, these are borrowed funds, you know, that you have to turn around quickly and get it back, and other costs that are also still going up that you've rented a branch, the month is due, you have staff salary, you have to deal with other costs, other things, products that you've done that you are servicing, and all these challenges. But when people turn to you as Mr. World Bank, they forget about all those challenges.
I mean, you are absolutely right. The sympathy of the nation normally it does not really lie with banks per se. We have a soft kind of target for the population, and sometimes you receive a lot of flack for things that we do not cause. And people normally, ordinarily forget that we also exist in the economy, and whatever challenges individuals are going through as bankers, as banking institutions, we are also facing similar challenges. We are a residual recipient of risk in the country. So if, because of where interest rates are, businesses are struggling to pay their loans, who gave them the loans? It's the banks. So who is going to bear the risk? The ultimate risk the businessman has taken is the bank. If you are a salaried worker, you took a mortgage when the rate was maybe 5 Ghana cedis to the dollar, and all of a sudden it is 10 Ghana cedis to the dollar, your salary is fixed as a certain amount, all of a sudden your debt service ratio, instead of maybe 40%, is like 70%. You have other obligations you have to meet. If you are struggling to meet your obligations or repayment expectations from the bank, who is bearing that risk? It's the bank. So sometimes we simplify the pressures and the risks that the banks assume, particularly in settings such as the kind of economic climate that Ghana finds itself in at the moment. So it's as I said, it's a very delicate balance. The staff of banks are just like any other people. Just like people are struggling to buy fuel, people are parking their cars or having short trips or doing ride sharing, and it's the same thing happening in the industry. So we are not exonerated from the pressures in the economy, and to that extent, I would say that just like any other economic actor, the banking institutions are also really going through some tough times.
You talked about, earlier on you spoke about servicing loans and all the rest. Mr. What would you tell those who would also argue that Mr. World Bank has to also do a lot of due diligence to ensure that when George Wiafe walks to your bank, he's able to pay for that loan that he collects, and maybe the due diligence and assessment is not done, and that is why we have situations where a Kopna Mensa is struggling to pay their loan, and the rippling impact of that on the entire economy and even the bank itself.
Due diligence is seen in manifests in several forms. But if you have an economic situation induced risk, which you may have planned when a bank is lending, they take a whole lot of environmental factors into account. So they may have projected that inflation, which was 9% not too long ago, maybe at max will be around 10, 11%. All of a sudden, we are talking about upwards of 30%. They would have projected, based on the cash flows of the borrower, that, oh, your cash flow projection gives us an excess cash flow of X amount, based on which we can give you Y amount at this interest rate. Now, policy rate has increased from 17% all the way to, where we have it now, in 20s. And how do you factor these unexpected, unplanned environmental factors that you do not control? So if because of that, the cash flow pressures on your borrower is such that they cannot pay, it has nothing to do with the level of due diligence that you undertake. You would have taken all factors into account. But the kind of situation we are, who would have predicted that the currency, which was depreciating at 3%, 4%, all of a sudden will shoot to 30%? Nobody. I'm not sure there is any. All
your models. I know the banks, you have a lot of modeling and extrapolations and all those things that you do.
Very sophisticated modelers, talking about the rating agency, they did not foresee this coming, that the Cedi will go at this time, over 30% of depreciation. That the Ghana reference rate, which was around 13.5% not so long ago, will go all the way to almost 24%. Nobody can predict this. We couldn't have predicted it. So no matter the level of due diligence, which banks, because of all the issues that we've gone through, have really taken the trouble to ensure that the facilities they put on their books are strong, and these facilities are self-liquidating, can take care of their repayment. If these environmental factors cause a stress in a borrower's cash flow, your due diligence will not solve the problem. If impairment is coming, you have to prepare for it.
How is the current, you spoke about policy rate, and we look at the reserve rate as well and all those things. How is the current environment? I don't want to focus too much on Bank of Ghana data. Some would say the reality on the ground. How is the current environment affecting your members in terms of lending to people? Because now you want to be extra careful to ensure that you don't hit by any bad debts because of the current environment and all the rest. I would want to move away from BOG data, the reality on the ground. How is the current environment affecting your members in lending to the real sector of the economy?
Yeah, I make this point every time that banks play in the middle. Banks make their money from margins. They don't make their money from high interest rate.
Interesting.
And when you trend the banking sector's net interest margin, we just did an analysis not too long ago.
And what did they say?
It's coming down. The net interest, the NIM of the banks is coming down because when rates came down quite drastically, somewhere 2019, 2020, where rates came all the way, banks were lending under 20%, and the average lending rate was
borrowing.
Yeah, and there was a lot of borrowing, but the net interest margin of the banks was on a downward trend. So to the point that you raised, if loans become, the interest rate or lending rates go up that level, loans become almost unaffordable. It becomes difficult to take money at 30%. What business are you going to run to make so much money that you can set financing cost 30% aside, pay salaries, pay for your everything, and still make profit? So when rates are at that level, banks are concerned, because then the interest burden on borrowers becomes heightened. And when interest burden is heightened, even good borrowers begin showing signs of distress. And all of a sudden you find that your impairment expectation is also going up. And then bottom line is hit. So it's a very difficult period for banks. And it is not like we are sitting here and thinking, oh, lending rate is high and because of the banks are making, but I'm telling you, the reverse is the case.
I mean, again, I earlier said that about moving away from the data, but for that Mary Mensah out there who has monitored this industry so much, she will struggle to appreciate this hard data that you're explaining to us, that when the rates are high, a Johnny World Bank is not making some good returns.
Sometimes we underestimate the understanding of the general public. They are better economists than ourselves. Okay. They understand these things, perhaps not the jargons, but the implications. They understand it. They know that if I was receiving 10 Ghana cedis and my borrowing was taking 5 cedis from me, all of a sudden that loan has been repriced. I'm receiving the same 10 Ghana cedis. My borrowing is now taking 8 Ghana cedis from me. I have 20 Ghana cedis disposable income. How am I going to manage with 20 Ghana cedis? I'll talk to my bank. Is it possible to reprofile this loan? Can we have an extended tenor so that the repayment burden on me can be tapered a bit? And those discussions are going on. I'm sure people are talking to their banks. Businesses are talking to their banks.
Is that the situation now that there are more requests from businesses to reprice these loans that they borrow because of the current challenge?
We do not. I don't have the
data. Not going to hard number, but
it is an expectation that it is what it is, that rates are at that level. When we did the cash flow projection, we were at this level. My excess cash flow or my shortfall was this. Now all of a sudden my shortfall, combination of a high interest rate and currency depreciation and high inflationary environment, my excess or my cash flow level is now at this level. What as a bank, what would you do? You have to sit to the business and say, what can we do to support you? If it means to reprofile, as for reducing the interest rates, I'm not sure that is the way to go, because the bank also has a cost to pay. You understand? And perhaps the best way is to see your cash flow, your project, and see if it can be accommodated within perhaps a lengthier tenure. Maybe it was a 3-year facility, you have paid 1.5 years, all of a sudden you are struggling for the next 1.5 years. Is it possible to increase the 1.5 years to 2 years so that the repayment burden can be lessened? These are discussions that I'm sure
will be going on. And you think that you'll be seeing more requests from businesses because of these challenges?
That expectation is there. We don't have the data so far for that. We'll be testing the market to see to what extent that is the case, but that possibility is there.
How willing are your members in the banks to help some of these businesses who might come forward with that request or with that request?
Banks like to say to their customers, they like to say to them to understand their business, to understand their financial needs. So if part of that discussion would mean that they take a second look at the lending that they've given you, or the funds, or your repayment, your next repayment date, and if it means that they may have to take a decision on a few pillars, either reducing the repayment amount by extending the tenor, or maybe taking a decision on even additional funding, so that you can, weather the storm. When it comes, we are in it together. If you are not able to pay, the risk sits with us, and we have to support you all the way to make sure that that support sustains you over this crazy period, if I should put it that way.
There were 3 things. Has there been a slowdown in? Again, that's something that, BOH data will give us scientific numbers, but just a careful look around and that scan around the market. Has there been a slowdown in terms of request for loans because of the fear that these businesses themselves understand that, listen, we cannot pay these things back? Or rather, the banks are also being strategic, that there are limited funds, and in this period, I want to be strategic how I lend. What is happening right now? Is the banks rather being more cautious, therefore I want to hold on with the funds that I have at the very high cost that I've borrowed, or automatically request is going down because of what is happening?
Yeah, when it comes to lending activity, it takes the 2 legs to tango, you understand. It takes the customer to make the demand, and then the banks to assess the customer whether they qualify for what they are asking for. I do not have available data to say that demand for facilities have gone down, or the banks are unwilling to lend. As for the bank side, in all the discussions that we've had, and we talk a lot amongst the bank CEOs, when, in this environment,
we
have a platform where we discuss these kind of matters. And there has not been any kind of plan or a scheme to reduce lending. But it's the factors governing your banks, maybe your liquidity position or your own assessment of the risk factors in the terrain, will take a decision whether to go the way you are projecting or to slow down a bit. And then also from the demand side, it's incumbent on businesses to also make the assessment whether at this time, taking loans at 30%, you will be able to make sufficient returns to repay your loans and also meet your other commitments. So both, partners making this kind of assessment and analysis. And I'm sure once the businessman does the assessment and still believes that they need the facility, the bank will also assess the facility under the current circumstances and say, will this customer be able to pay back? If yes, of course, lending will take place.
And I asked that question because I'm saying that if there are pressures on your liquidity and you're borrowing at a very, very high cost, the prudent thing to do is to be very strategic in the growth of that loan book.
You see, when we say the growth of that loan book and you are linking it to liquidity, it's a different discussion. If you are linking it to the general economic factors, it's another discussion. Yeah, okay. As for the liquidity, you said we'll come to that, but as for that, even increasing it from the 8% cash reserve requirement from 8% to 12%, introduce sufficient stress, liquidity stress on the banks. Banks, yes, no matter what, they do everything to meet the regulator's expectation so that you avoid sanctions. So the banks will do everything to meet it. But it means if we're projecting to say give 100 million Ghana Cedi loan in September and your liquidity projection points to a position of liquidity squeeze, which means giving the 100 million may lead you into maybe having troubles meeting the cash reserve requirement. You are, a sensible businessman, and you take a decision and say, instead of giving 100, should we give 40 or should we give 60, so that we can create that liquidity space to enable us also meet the regulator's expectation. So that is real. That is, there's almost a direct correlation, depending on the size of excess liquidity in the industry. There's almost a direct correlation between cash reserve hike and potential risk to additional lending.
And since you've spoken about that, I think it might be a good time to also get your thoughts about it. I mean, policy rate hike by almost 300 basis points to 22%. For you, let me first get from the industry's perspective about this. What do you make of it?
You see, there are two key economic policy angles that we use to manage an economy. We have the fiscal side and we have the monetary side. The fiscal side, we know discussions are ongoing with the IMF on a program. We don't know what is in that box, so we cannot talk about that. On the monetary side, the central bank's assessment is that there's excess liquidity in the environment, which is pushing up prices and also putting pressure on the currency. And for that reason, they had to take a decision on making Cedi assets attractive. The way to make Cedi assets attractive is to increase the policy rate so that George Wiafe, instead of going to buy dollar, you decide to buy a government bond or a government paper, which is now upwards of 27-28%. That way, we get that liquidity from you. Your ability to go and buy dollar is limited, and therefore the pressure on the currency will come down. That is the theoretical base. You understand? So that's the Bank of Ghana's assessment. And to that extent, to the extent that there is that direct link between the rate hike and people's movement or the banking population's movement to Cedi assets, and therefore a lesser liquidity in the environment, therefore causing lesser inflationary pressures, I think it's a good decision. But also, we have inflation over 30%, and then you have market rates, policy rate around what,
22%.
So that negative return, the negative return that poses, it's a concern. It should be a concern to every banker, every investor, every banking, customer. That when I give money to a bank or to government, I get a return of maybe 25%. Inflation is 30%,
30%.
and therefore have a negative return of maybe 5%. It is a concern. So one of the ways of bridging that gap is also by increasing this policy rate, which then brings the market rate to a certain level, which gradually will catch up with inflation, unless inflation also comes down to catch up with the market rate. So to that extent, to the extent that there is that direct correlation, and the central bank, they are the experts, they see the bigger picture, they have all the data available. So we support the fact that if that decision addresses the problems and the instability we are experiencing.
Earlier on, I tried to explain or draw the correlation between, or trying to move away a little bit from the hard Bank of Ghana data to the reality on the ground. Bank of Ghana says that there is excess liquidity, that is why we are hiking the policy rate. Are you sitting with a lot of cash that is not
Bank of Ghana
that is making, I mean, let's even restrict ourselves with cash in the banking system and not cash outside the system. And the Bank of Ghana, we hear from the Monetary Policy Committee during their meetings was that one of the things that they are trying hard to correct is excess liquidity in the system. Are your members sitting on a lot of cash that they don't know what to do with it?
Sometimes you don't want to go contrary to Bank of Ghana's assessment of the liquidity position because they control money supply.
But that's the reality on the ground.
No, but the money, I mean,
money's in the banks, not outside the banks.
They know the quantum
and the perception is that Mr. Woes members are spending a lot of cash.
I'm not sure that is the perception. The point is that as the regulator and the central banker of the country, they control money supply. They know how much of money has been printed over the years and the total money supply in the country, how much of it is in the formal sector and how much is in the informal sector. So to the extent that they've done assessment and they have come to the conclusion that there is excess liquidity, I cannot question that. What I can say is, even at the 12% cash reserve requirement, we had liquidity pressures. And sometimes banks had to struggle to meet the liquidity requirement. Of course, it depends on what your available liquidity has gone into. So there's possibility that you have also overinvested, maybe in some short and short-dated instruments, because you use that to also balance your liquidity position. And to that extent, I would say that if the central bank makes that assessment, I'm
not going to let you question, because as a layman, if I hear a regulator talk about excess liquidity, I want to think about monies outside the banking system and money in the banking system. And therefore, I will make that layman assessment that Bank A, B, C, D is sitting on a lot of cash, and that is why it's fueling certain questionable investments.
When there's speculation in an economy, you also have a growth of the informal sector, because not all the money perhaps that have left the banking system to chase dollars in the informal sector, perhaps not all those dollars have found their way back into the bank. So it is out there as excess, but perhaps not sitting within the formal banking system. So these measures, if they move to the plan or the expectation, are supposed to reduce those pressures, and the people who are holding dollars may begin taking decisions on whether to unwind their positions, because perhaps because of all these measures, the rate either will completely stabilize or perhaps see a little bit of appreciation over the medium to long term. And therefore, if you are holding dollars, you can potentially also, face some risk, in the horizon. To that extent, yes, there's that possibility that the informal sector is contributing to the excess liquidity.
So if Governor Jones at Bosokan sits down and hears about excess liquidity and says that the World Bank is sitting on a lot of cash, it's wrong?
Okay, let me take it this way. What I would say is, to the extent that at 12%, banks were really under pressure to meet it. Means that there may be excess liquidity, but within the industry, we are seeing hiccups in liquidity. So perhaps as banks unwind their positions in their short-dated instruments to balance their liquidity position, we may see a little bit of stability in that that metric here.
So we'll be coming back to you to get your thoughts, and you spoke about reserve requirements and how that is going to impact on your operations. And also the biggest elephant in the room, the Ghana cedi, and what is the banks, or what are the banks doing to help with the stability or contributing to the current challenge? This is PM Express Business Edition as we talk about the Ghana cedi and what are or what can the commercial banks do to deal with the current challenge facing the local currency and its attendant shocks to the larger economy. It's PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition as we talk about the current challenges facing the Ghana cedi and what are our commercial banks doing to deal with this current challenge with respect to the liquidity issues, the policy rate hike, and the reserve requirements, and how is that hitting the operations badly. I'm engaging Mr. John Ewa. He's Chief Executive of the Ghana Association of Bankers. Mr. Ewa, thank you so much for having time for us. And we're talking about the reserve requirements. I mean, 13, 15%. How is that impacting on your operations? And I still want to draw the connection again to the excess liquidity thing. I mean, how is that impacting on your operations, some would say?
It's steep. If you link it to the fact that we are just coming from 8% cash reserve requirement. So by the time we get to the 15, that would have been almost a double of what we used to experience, which means for every 100 Ghana cedis a bank takes from a depositor, they have access to 85 Ghana cedis to do business. So it's big. For every dollar you give to a bank, they have to reserve that dollar in Ghana cedis. So that also increases additional stress. So when it increased from the 8%, the actual prudential rate advised by the central bank is 10%. Then because of COVID, as part of the measures, COVID measures, it came to 8%, which was a good thing. Then, we went almost post-COVID, things were returning to normal, and then it moved to 10%, also an attempt to sap out or mop up liquidity from the system, when the inflationary pressures commenced. Then from 12%, we are heading to 15% by November. It's steep, and that potentially will take out almost 4 billion additional cash.
That is from this recent 300% hike?
Yes.
Yeah. Sorry, the reserve requirement.
Yes,
sorry,
yes, almost just about 4 billion in additional cash reserve taken out of the banking industry. That is 4 billion that potentially could have gone into lending or into other assets. So to that extent, it is a big hit to the industry and potentially could have an impact on lending.
That bad, some would say?
It's being used to address a concern that we all are feeling, which is inflation. That when there's so much money in the system, you all know more money chasing fewer goods, and then you have inflation. And also the fact that we have significant gap. With, the negative return gap is too big and it has to be bridged. You cannot force inflation down, but the monetary policy can be inched up to meet inflation, and gradually as inflation trends downwards, then perhaps we'll begin having the positive return that we are all used to. So to that extent, we would say the measures perhaps are for stability, not necessarily for growth. Because for growth, then you want to put more liquidity out there, people get money, people spend, production goes on, taxes are paid, and then you have growth. But as it is now, the priority of the managers of the economy, particularly the central bank, is to stabilize the economy or to stabilize the financial system. So to that extent, and to the extent that it goes to stabilize and give us all the stability that we are looking for, even if currency is depreciating at a, not an accelerated rate, at a depreciating rate, just a little kind of depreciation, as we've been seeing, 3%, 4%, which is good for an economy the size of ours. If there is inflation, just about a year or so ago, we were in single-digit inflation, which was good. And we were almost lending, a lot of the banks were lending below 20%. The average lending rate came as low as 20.5%.
That is the reality on the ground.
It's the reality on the ground.
I see.
There are companies that took loans at 18% from the banks. Actually, some below 18%.
Blue chip companies.
Yes, but they are all in the country, and they employing Ghanaians.
Yeah.
So
that man at Abosokan wouldn't get that access to that 18, no matter how good his books are.
No, not if your books are good. Yes, talk to your bank.
That man at Abosokan will get a loan from your bank at that rate. If his books are good, operated for like 20 years, his cash flows are solid, he has hardly defaulted on a loan.
I can say with all certainty that there are businesses of that nature who are enjoying rates that your blue chip corporates would ordinarily get.
Is that the reality?
Oh, no,
you've been a bank MD in several banks before.
It's more about the risk.
It
is more about
operated for 20 years, good cash flows, has hardly defaulted on his loan. It's going to get a loan at 18%.
I can tell you when I was on the other side, for corporates or businesses or SMEs such as that, we were giving loans sometimes even below the rates we were giving to some of our corporates. It's relationship and understanding of the business of the client and the track record of the business. The business has never defaulted. It's always, properly managed. The money given to the business is being used for the activities of the business. Repayment has never been an issue. The risk profile of the customer is at the barest minimum. Why are you going to overlay such a customer? In fact, that customer will be the toast of the industry. And therefore, if you go and even overlay, competition will kick you out because you are not exclusively banking the customer. Right? So to speak, the customer has the freedom to move to any other bank. And if they are that good, and you are giving them a rate that is not commensurate with their risk profile, they have the freedom to move. So I can tell you that there are several of such customers within the banking population who are getting very good rates. But when you talk about good rates, what is good rate?
Competitive rate.
Yeah. So competitive rate at what level? Banks can all price competitively at 30%. Is it a good rate?
It's a high rate.
So when people say competitive rate, it depends on what competition is doing. Competition reacts to market fundamentals. So if the market is placing lending rate at upwards of 20, 28, 29, 30%, that's where the competition will be operating. But is that the rate that gives that businessman the liquidity ammunition in order to prepare the production cycle? I don't think so. So we need to all focus on the things that can bring the rate down. And that is what central bank has done. One half of it, and the fiscal side will do the other half. And then the two together should push us into that arena where we were operating 2 years ago, where rates were coming down, actually at some point almost aggressively. You understand? So we've been there before. It's not like
I'll come back to you about whether a single-digit interest rate is a reality or a wishful thinking. But let's come back to the Ghana cedi. And there were some who were arguing that it was this excess liquidity on the part of some banks. Or before I even get into that, earlier on you spoke about the fact that, you were surprised at the rate at which the Ghana cedi was depreciating. Surprised?
Yes,
or was expected, some would say.
Of course, every year we have an expectation of a depreciation. And depending on the fundamentals on the ground, the depreciation operates within certain tolerable confines, if I should put it that way. Nobody anticipated 30% and above depreciation by August. Today is what, 22nd or 23rd?
Yeah.
Nobody anticipated, 24th, yeah. So I'm not sure the market anticipated this. So to that extent, I'm surprised.
Really?
Yes.
Didn't all your projections, your modeling,
of course,
give you a picture that this is what is going to happen?
That picture was there, that given the fiscal gap we were having and given all the global factors and the fact that the advanced and well-to-do economies were inching their rates up, of course, if the United States coughs, you'll catch a cold. So if the Fed keep increasing the rate to where it is now, of course, if you are an offshore investor with an option of investing in United States bond, that will give you 7%, 8%, and you are in Ghana getting bond that is giving you at the time 19 or 8, let's say 22%. When the currency is depreciating now 30%, you have a negative return when you are going back. Your 7% is dollar to dollar. You are okay. Even if you invested in another currency, because of the strength of the dollar, you are still in the money. So to that extent, there was that expectation that given the global circumstance where the advanced economies were also inching their rates up in response to inflationary pressures. The United States, United Kingdom are all having all-time inflationary pressures. Some over the last 40 years, they've never seen
this rate
what
before.
the rate we are seeing now. So it's not, Ghana is not in isolation. The extent of ours is more pronounced because of the rate of inflation, where it is going to. But I saw a projection that said that even the UK may be going into 14% in the next 2-3 months if things go the way they are going. So the pressures are there, they are everywhere. But it is, to what extent is the pressure translating into the inflationary pressure in our country, which has moved from as low as, I think at some point almost 8 or 7% to 31.5 or thereabout that we have at the moment. So the expectation was there that as the advanced economies or the well-to-do economies, had this kind of rate, upward hike, cash will move from our system. And when the investors are moving from an economy to chase better yields in another economy, they are like crazy people. They are, the rate is at 5%, you tell him it's 5.5, you say, okay, give it to me. Once you give to him, because of the size of the portfolio, once you exchange at that rate, that almost becomes the market rate. So the next time, that is the rate people are going to quote. And the next investor who wants to exit in response to better yields elsewhere, and also in response to all the problems we have gone to the downgrades. There are some offshore investors who have a policy not to invest in CCC countries. So once you get to CCC, there are investors that will have to exit by policy of their companies. When they are going, they've reached their stop loss level. So when they are going, they are like, they exit at any cost. And when I say at any cost, it means whatever rate they get on the market, they will take and exit. And when that happens, it puts pressure on your local currency because they have local assets and they want to convert and live in dollars. Ghana, we have finite dollars. If you have finite dollars, just like any other, but our size is very kind of tight.
Small, yeah.
So if you have all of a sudden these kind of pressures, we also had this significant increase in oil prices, and when we are buying oil, we use dollars. And all these things coming together, everybody looking for the same dollar to pay for the oil, for the offshore investor who is going, and for the people in our own households and businesses who are also unnecessarily speculating on the currency. You have a perfect storm, which will definitely result in a significant depreciation of your currency.
Mr. Well, what would you tell those who would argue that this perceived excess liquidity forced some of your members or some banks to chase these dollars or to place in dollar assets or euro bonds and all the rest? And that is a contributing factor.
No,
Are your members not rational to get dollars both from formal means and even
banks,
black markets?
If a bank is looking for dollars,
because the Bank of Ghana is not giving you all you want.
Yeah, if a bank is looking for dollar, a bank is looking for dollar to settle a transaction.
Aren't you stocking up dollars for your own transactions? Is that not the reality?
The more dollars you keep, the more cost you keep as a bank, and the more risk you introduce in your books. And more so, you have to balance your books, currency-wise, and also in your profiling-wise. So you cannot just buy dollars. For what?
To meet the demands of businesses that are coming to you to ask for dollars for transactions.
The central bank,
and that is where the argument was that you had so much liquidity that you were going out to get dollars. There is
so much liquidity a bank can keep. And that's what the Bank of Ghana calls the net open position. Every day, you send the return on your net position in Forex to the central bank. And that net position has a bearing on you, the size of the bank, the size of your net own funds. So you cannot just be buying dollars. You will breach your net open position. And if you breach, there are sanctions. And those sanctions will more than account for whatever benefit you get from buying those dollars. You understand? So if a bank is in the market looking for dollars, or central bank looking for dollars, it is to settle a trade for a customer. An oil company is settling an LC, or there's an importer who needs to settle a bill, or any other form. Somebody like you, you like to travel, you come, you have a limit of 10,000 Ghana cedi, you show your ticket, you show your visa, the bank will give you the $10,000. If you have all these things happening, Yeah.
Mr. Well, I ask this question because I look at the auction results and I know the majority of the bids are coming from the banks. You are not getting the Bank of Ghana to meet your request. How are you then getting the other sources of dollars or other dollars that you need to finance those LCs and demand from other businesses?
And that is where the problem is. The problem is, what is the size of the dollar demand, the actual size? What we are seeing, because of the speculation, we are seeing situations where you need $100,000. You are not sure Bank A will give you $100,000. So the same documents you take to Bank A, Bank B, Bank C, Bank D, they are all holding your $100,000 document looking for $100,000 for you. What is the multiplier effect? There's $400,000 demand on the market, which would go to also affect the rate because of the size of the demand. But the $400,000 demand is for one customer who actually needs $100,000. But we all go and place a bid. We will give you 10.1, 10.15, 10. For $100,000 that is spread in 100,000.
Is that the reality on the market?
It is happening on the market. That is the only reason why the central bank came up with a special window for the oil companies, because we saw that happening where the oil companies were shopping. You understand? So with the same LC documents or the same settlement documents, they will move to 2-3 banks. All 2-3 banks will come to the central bank for FX support. What is it? It's a duplication of the demand. So as a country, we do not really know the real size of the demand.
That is interesting, some will say.
Potentially also contributing to the currency situation that we have. And it's a concern. And that is why we advise customers that if you do not need dollars, do not go for dollars. Because the moment you do that, you are preventing the person who really needs the dollar today to do business from getting it. We do not have dollar in abundance. It's not our currency.
But Mr. Kwatin, who is into import business, and looking at the way the cedi has depreciated, the best thing to hedge his investment is to grab as much as dollars as you can for October, for November, and for December.
Yeah, but the thing is, the more dollar you grab now, the more pressure you continue putting on the currency. And the less beneficial it becomes to you next time you want dollars, because then you pay a lot more.
Are you telling your clients this?
That is what we have to, and that's what...
But are you doing that, some will say?
Oh, I'm sure the banks are doing that. I wouldn't say there is a campaign going on, but I'm sure we are telling the client. As for the banks, it is difficult to just buy dollar from a bank and keep. I have 1 million, please convert to dollar. I'm not sure there's any bank in Ghana that will just do that. No.
They are not buying dollars from the black market to meet their dollar needs because they can't know everything that they want from the Bank of Ghana.
And it is the customers whom we have to target and educate.
And not the
commercial banks. That the more pressure you put on the dollar now for something you need in December, the more risk you yourself will face subsequently, because then to get the same dollar, you will need a lot more cedis. So if we all come to that understanding that we will buy the dollars when we actually need it, then the pressure on the currency will begin coming down, and then the level of depreciation will slow. It's a very simple mathematics. It is demand that is fueling the excess. It's demand chasing fewer dollars that is fueling the price.
Mr. Well,
if you come to the market and you say there's $2 million position in the market and the demand is 1.2 million, what will happen to the price? People will begin pricing down to get the 1.2 million.
Mr. Well, speaking as an MD before in these commercial banks that you've heard before, do you think that this demand is as a result of, quote, real demand or speculation?
I think a greater percentage of it is speculation.
Interesting to say. Well,
I went for a meeting 2 weeks ago, and after the meeting, normally after the meeting there is informal, things that go on. We talk and we discuss a few things that may not be related to the business of the meeting. Afterwards, the officer I saw just said, "Oh, I have some cedis, so can you help me to get dollars?" I said, "What do you need the dollar for?" "Oh, I don't need dollar now, but the way the rate is behaving, I want to buy." I said, "No. Government bonds, that is why the central bank has increased the price of the government, like the price of market rates. So government bond is now trading upwards of 27, 28. Why don't you buy the bond?" He said, "Oh, okay, then I'll talk to my bank, and then instead of buying the dollars, I'll buy them." This is the kind of education, because that is the essence of the rate hike. to shift from this pressure on the dollar to, CD assets, so that people begin shifting their portfolios, and then the pressure on the currency will begin dwindling. So I can tell you the speculation. This person I spoke to didn't need the dollar for anything.
But Mr. Ward, that is interesting, because there are some who still believe that it's real demand, it's demand coming from the banks that is pushing the pressure on the currency.
Yeah, I mean, of course, if you have oil prices, going the way they went, and you have the offshore investors who are also exiting in their numbers, of course, the demand is also there. The demand is there, and Ghana is significantly import dependent.
But a chunk of that is coming from people who are afraid that things will get worse. So let me rush and demand the dollars.
Yes, we have cause to believe that that is also controlling a significant portion of this.
So what would you tell those who would argue that, listen, the best form of discouraging people from going after dollars is stabilizing the Ghana cedi? And that is it. People would not be forced to push for dollar assets. I
think you are preaching to the converted. Basically, that is it. That is what we all need, is for people to move into the currency we are all familiar with. For those of us who are fond of buying imported stuff, creating the demand for imports, and therefore more pressure on the currency, to also begin changing their consumption pattern. Those of us who like foreign foods, we import from toothpick to whatever, you name it. The lapel pin you have over there was imported. Everything we have is imported. What does that do to the local production? How do we get our local industries to be competitive if they are being crowded out with cheaper imports, and in some cases, which is something personally I significantly do not endorse, have discount on import values? I do not think, as a country that is reeling under the pressure of dollar, when we do not have sufficient dollars to import, is the same country that should be giving discount on import values. I personally do not think that is a very, should I say, the consistency between that policy and the need for export-driven economy. I don't think they align.
Mr. Wa, how committed are the banks to strictly enforcing the FX rule? Because there are some who are arguing that when we saw the pressure on the Ghana cedi, the people who were rushing to open dollar accounts, and there is nothing wrong with that. Was that the reality on the ground?
Not that I have the data to support rush to open dollar accounts, but to your question on whether the banks really want to support with the currency where it is going, of course, yes. As in strictly
compliant with the FX rules?
Of course, yes.
Are your members doing that? Are your banks doing that?
Oh, they are doing that. If you don't, the regulator is there, and the documents are verifiable. So the regulator
do not come to buy dollars from your end, over-the-counter transactions.
I can't sit here and really dictate what banks are doing. My presumption is that banks are complying with the regulatory requirements. And the regulatory requirements is that all dollar purchases must be supported with appropriate documentation. All dollar expropriation or export of dollar, or whatever you want to call it, must also be supported by proper documentation. These documentations are spelled out in law or in regulations. If you are a bank, the minimum expectation is that you comply 100%. There is a little bit of leeway for advance payment with that documentation. But even that, there are constraints. If a customer comes and says, I want to import from, say, China, you have a limit of up to $50,000 worth of imports that you can pay for advance before you receive the documentation, and then you submit the documentation to the bank, and your situation is regularized. If you don't do that, the law is that the bank should not allow you to ever make any advance payment. So these are all constraints within the system to manage FX outflows. So aside the fact that the banks have self-compliance mechanisms in place, the central bank also cranks the whip. Of course, yes, they also crank the whip. And they do this through their unannounced visits, their routine on-site visits. They come, they pick all your FX outflows. They say, bring us the documentation, support each one. For each one you don't have documentation, there is a sanction. And I can tell you the sanction is much higher than whatever return the bank would have made on the transaction. So the motivation to do that is also not there.
Not sticking to a data from all the members and even from your engagement with your colleague CEOs. Was there a pickup in dollar account opening as a result of the sharp depreciation of the
I don't have the data. I don't want to
that was not speculation, but that was what we heard.
Okay, I don't like to speculate. Just like you're talking about speculation, it's a dangerous venture. So if I don't have the hard facts, I don't want to commit to anything in that area because I don't have the statistics to back it. We can look for it. We can check with our members and get the data, and maybe in a subsequent interview. Or
so someone said you don't need data looking at where you're coming from to comment on
this
particular issue.
You can say a lay analysis is that if people are buying dollars, where are they keeping the dollars? If they're not keeping it under their beds, they are keeping it in the bank. And if they are in a bank and they don't have a dollar account, the sensible thing to say is they will then request for a dollar account. If you want to base your conclusion on that kind of analogy, I won't stop you from doing that. But I don't have the data to support a significant dollar account opening because I don't have the data to support it.
Are you optimistic? There are some who are saying that from next month we are having Afri-Exim coming in, all other things being equal. I'm using that expression. We are looking at a situation where cocoa loan syndication should be coming in from next month as well. Government is going to commence negotiations with the IMF for a program possibly next month. All these things will impact on inflows. Is it also your expectation that the high rate of depreciation could be slowing down?
Of course, yes. We have great expectations from all the things that you have listed. The Afri-Exim, 750 million, which we believe is coming this week. The cocoa syndicated facility, which also likely coming somewhere next month. And then we have the program negotiations that is also kickstarting. What do the international community or the international investor community, what are they looking for? They are looking for a situation of outlook that is pointing to stability. So how do you support your currency? How do you ensure that your currency does not depreciate aggressively? Is to have the foreign currency to support it, or assets to support it. So if we have sufficient supply of dollars coming in, then the ability of the central bank to intervene more in the FX market is enhanced. And what that does is builds up market confidence. And people who are speculating will now begin seeing that the rate is even appreciating and then we are losing money. And they may also start selling their dollars. And gradually that sends a signal to the market that there's semblance of stability. And that should taper the kind of depreciation that we are having. And we are placing a whole lot of our analysis on these things happening. And we have the conviction that these are going to happen as well.
This is PM Express Business Edition as we talk about the Ghana Cedi's woes and what are the commercial banks doing or not doing to try and deal with the current challenge. I'll be getting Mr. Woes' thoughts on whether we've done what we have to do on the regulatory and the monetary side to try and stabilize the Ghana Cedi. And what about the fiscals going forward? What are those things that need to be done to complement the efforts of the Bank of Ghana to deal with the current challenge facing the Ghana Cedi? It's PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition as we look at the Ghana Cedi's challenges and what are the commercial banks doing to help deal with the current situation and the current challenges on the ground. And Mr. Wa, I was just trying to get your thoughts about, for you, do you think that we have seen the worst in terms of inflation, or it's early days yet? A little concern that I have is listening to the government statistician. The last time, what he said, that the pressures persist, and that tells me that the inflationary pressures are still evidently with us. And we are thinking the central bank's measures, the recent ones, should help to reduce the pressures that we have on inflation. But as I said, most of our inflationary pressures are imported. That combined with the level of the currency depreciation, of course, is what has heightened the inflationary pressures that we are going through.
So to the extent that all the packages that we talked about will take care of on the currency side, at least to de-accelerate the pace of depreciation, and also the hike in the policy rate should also help to move liquidity traffic to Cedi assets. That should also help in bringing down the pressures that we have on the currency, and also the inflationary pressures that we have, because as people have less liquidity, then their ability to put pressure on prices of goods and services will also, come down in tandem. So yes, I believe that the pace of acceleration in the inflationary pressure will begin going down. We were somewhere 17% not too long ago, and we are 31, which means really we've run on the inflationary pressures, and I believe going forward we are going to begin walking, and then we will start crawling, and then perhaps we will start almost having a deflation period where the rate will start coming down.
So thank you so much for your time, and I appreciate it so much. I know the debate and the questions will still go on in your house on what still can be done to ensure that we firmly stabilize the Ghana cedi, and whether the banks are doing enough to help with the situation. This has been PM Express Business Edition, as you looked at the Ghana cedi and what the banks are doing to help with the situation. My name is Wiafe. Have a great day.